right, welcome everybody to Capital Realty's regular Wednesday meeting. Today we have a guest. Jason Roberson is here from Guardian Residential Lending. Thank you, Jason. Jason's been with us before on our meetings, and he's here today because we want to discuss what a lot of you have been talking about and asking about, that you've been hearing in the news about the new rule going into effect as of a few days ago, May 1st, from the FHFA, the Federal Housing Finance Agency, has put out this new rule that, and I'm just going to read the rule as it's written because I know it's a little controversial, and we're trying to separate myth from reality and fact from fiction. So under the new rules from the Federal Housing Finance Agency, set to take effect May 1st, borrowers with lower credit ratings and less money for a down payment will qualify for better mortgage rates than they otherwise would have, while those with higher ratings will pay increased fees. Now, I didn't take that. I just Googled that, and it's the first thing that came up. I'm trying to be as middle of the road as I can. But there's more to it than that, and it's not simple. So, Jason, I thought maybe you could share with us what your understanding of how this works, and is this even a new thing, really?
Well, to kind of clarify, this rule came out in January. It was announced 3 months ago for loans that were going to be delivered, and this is conventional only, for loans that were going to be delivered to Fannie Mae after May 1st. So basically, any purchases that were closing before May 1st were going off of the previous matrix. But if say April 15th, you started a loan and it was going to close May 2nd, that one went into the new matrix. So the ruling came out, but it didn't really catch anybody's attention until the lenders started showing the differences in their price sheets. And then that's when people started getting the uproar, and then you saw the internet blowing up. FHFA put out a statement on April 25th to kind of clarify all of that. And one of their first statements for what they said is a misconception is higher credit score borrowers are not being charged more so that lower credit score borrowers can pay less. What they did is they had to restructure the matrix, because the matrix, the model that they were using was years and years and years old, like previous to 2008. And the market has changed. And the matrix is risk-based, saying that people who put 3 to 5% down, tend to possibly default more than somebody who puts 20% down. So they would give somebody at 20% down a better break because it was a less risk loan. Well, since 2008, that model doesn't work anymore, and what they found is that depending on the loan type and the credit score and the down payment, the loan to value, that it was kind of all over the board as far as which ones were failing, and Fannie Mae had to pay back and go into default. So the reason why this was taken up, according to FHFA, was because Fannie Mae has been undercapitalized since 2008, and they wanted to close the margin of the ability for home affordability. Their whole goal was to make homes more affordable to those who may not have had as much money or lower credit scores. Their income is lower, basically the income lower. So they rearranged it, and then they made changes, and that's what we're seeing. So the changes are kind of all over the board. And if you bring up those matrices that I sent you, Daniel, I can kind of point out the differences. And this is going to be still a little bit confusing when I compare one chart to another. So let's start with the bottom chart on that screen where it says purchase loans. If you compared the matrix that was in existence before the one that took effect on May 1st the differences in the pricing, this is the price of the loan. These are the loan level pricing adjustments that Fannie Mae comes up. So on the purchase, if you look, say for example, the red is the ones that got worse. And then the green are the ones that got better. And then the pink is just not as worse. Kind of in between the worse and the better. So if you look at the 780 credit score and you slide all the way over to 80 to 85% loan to value, that's 0.125. So between the matrix, old matrix, and the new matrix, it got slightly worse for that category of people who have 780 credit score and are only putting 15 to 20% down. Got worse by 1/8%. Then follow that category down to the next one, people with 760 to 779, it got worse by 0.3%. Then you go down further to the next one, and it looks like that's 0.75 for people who are putting 15 to 20% down and have a credit score between 740 and 759. It actually goes from 720 to 759. They're both the same. 0.75 worse. So then somebody who has a lower credit score of 700 to 719, it only got worse by 0.5. So
when we say worse and better, for clarity, when we say worse and better, we mean cost for getting the loan.
Cost, this is the price, the price for the loan. So it would be 1 point, so for example, the 720 credit score where it got worse by 0.75%, that's 0.75% of the loan amount of what the cost for that interest rate.
So for clarification, when you say cost of that loan, is that the loan origination fee?
It'd be well, it's attached to that, but this is that's the easy way to explain it. So this is what it's all based off of. This is what Fannie Mae has put out there. And then the lenders have their piece on top of that. That will, if you want to say kind of like an overlay, their pricing adjustment on top of that based off of their risk. You can see that the worst is that got hit with the change is the 720 to 759 putting 15 to 20% down. Those are the people who got hit the hardest.
It doesn't even show people with 800 credit scores who, if it's getting better as, someone with a decent credit score of 720, 740, those are good credit scores. But when you get into excellent credit scores, it seems to, 760 and above, 780 and above, and I'm looking at that 80% loan to value category, which is 20% down. It seems to get better the better your credit is at some point.
Over that 760.
Yeah. This is for people with excellent credit. This is a pretty small price to pay. And in a macrocosm of the way taxes work, this is the way higher income people do help offset the more disadvantaged. And I don't think most people have a problem with that concept until it gets into extremes. So this thing became so controversial, and I was one of those people. I was very upset the way this was presented, that people with good credit are going to be punished to help offset people with lesser credit when the people with good credit just worked hard to do all the right things. Is there a way this could have been presented differently? Because everything you just said made sense. They needed to overhaul the system. They needed to fund. They needed to change the funding. It's been needed for a long time. I mean, couldn't they have increased the funding, and then at a later date, if they had done that at a later date where they were giving these, I don't think anybody would have really been triggered by that, because everyone, especially people in my business, we like people with lower credit scores to a degree being able to purchase. The more people that can get into home ownership fulfills on our mission statement. because we believe that's a very important thing to do. And obviously, we're not talking about subprime loans or that debacle. We're not talking about 500 credit scores, But is there a way you could have seen this being presented where it wouldn't have created such an uproar?
I think and this is my personal opinion, is I think FHFA could have foreseen some of this question, because anytime that there's a change, of course, it could be a small change like this, but then the internet likes to put it, make it 4 times bigger than it really is. I think they could have anticipated some of the questions that were going to come out, and the statement that they put on April 25th, they probably could have had some of that information out there better, and probably had a matrix more like this.
And was this chart on the FHFA website, or where did you find this chart?
No, this is on Mortgage News Daily.
So Daniel, you have a question about where they made these changes and why.
Yeah. I think, Jason, you touched on this a little bit earlier, but am I correct then that some of these areas where rates were increased or decreased had to do with the rates at which those loans were defaulting not matching up with the previous rates?
That's part of it. That's according to FHFA, they remember their goal is home affordability. So they want to try to close the gap to make people with lower income, which typically have lower credit scores, being able to afford a home. They had to restructure the model because the model that was in place prior to 2008 does not apply to today's market, because people are defaulting at different rates for different loan purposes. And so they did the analysis to find out what credit scores were defaulting, what loan to value, when they put their down payment, which ones were defaulting. And then they rearranged the matrix. So that piece, that tells me that that was part of helping make people with lower incomes, or lower incomes and lower credit scores, to be more affordable to be able to get into homes or maintain their homes.
Well, I was just going to ask, Britton, you had a question about what these numbers really represent.
Yeah, so just to be clear, these adjusters affect the closing costs of a buyer, and it goes towards affecting the interest rate. So these are like what you pay to affect the interest rate, correct?
Yes, these are adjusters to, let's say the interest rate is a flat 6%, and there's no cost for that interest rate. So that's what they call being par. To put this in perspective, if, say, for example, if we look at the matrix at 80 to 85%, that middle category there, if it cost 6% at par, then someone with a 780 credit score at 80 to 85%, it's going to cost 0.125 for that 6% interest rate. If you go all the way down to the bottom, if they had a 620, lower than a 620 score, or let's just use 620 because not a lot of people are under that get financed. 620 is a 0.375. So at 6% being par, they get a 0.375 credit towards the rest of their interest rates.
For everyone to get a uniform interest rate, and it doesn't matter what it is, let's say it's today's par interest rate of 6%, that it's the same rate for all these categories, but this is what each group has to pay to get that rate, in addition to other closing costs. But these are the adjusters. This is how much more they'll have to pay than just their origination fee, credit report, processing fees, all those normal costs associated with getting a loan, that you have to pay this much more to get the same rate as everybody else if you're in this category or this category.
But also, it isn't just pay because some people will be given a credit towards their closing costs.
Right. Yes. They will pay negative. They will not have to pay extra. They will get extra back that can go towards their closing costs. And, if they've got all their closing costs already covered, they'll be receiving a refund through their earnest money deposit at closing. So a good question had come up. If we were to look at not the changes, which is what these maps show, is the changes in the matrix from the old model to the new one. What if we just pulled up what the actual costs are, loan costs are, to get that rate based on what Fannie Mae has posted on their matrix, their most recent posting? Can you pull up the Fannie Mae matrix?
I can.
So this isn't color coded because it's not about changes, but just maybe zoom in on that top piece a bit. The credit score is listed on the left and the loan to value is across the top. So Jason, what are we looking at?
So this is the actual matrix that Fannie Mae put out. This is the most current matrix that they have. And so this is what they charge lenders for a particular interest rate. So based off of loan to value and based off of credit score. So this is the starting point for lenders. So a lender knows that if they have a 640 client with a 640 credit score and they're putting 80 to 85% down, there's a 2.5% fee that lender has to charge to, or that lender has to pay to Fannie Mae. So on top of that, the lenders have to make a profit. So this is what the lender has to pay. So the lenders have to make a profit. They don't want to sell that loan and then have to pay 2.5%. So they're going to pass that off into the interest rate and charge the borrower 2.5% for a particular interest rate. Then they have their adjusters on top of that. But let's say that there aren't any adjusters. Since you have to, they have to make that up. And let's say the 6% was 2.5%. They have to increase the interest rate in order to absorb that 2.5%. So if for that client 6% was 2.5% cost, then they may increase the interest rate to 6.5%, for example, and then that'll lower that 2.5% that's charged to the borrower as part of as part of a discount or origination or points.
But to summarize this matrix, what we're seeing here, with all things being equal, what this chart shows us is, regardless of the recent changes, the worse your credit score, the more you're going to have to pay to get that same interest rate.
Yeah, and that has not changed from the past.
Okay. So regardless of where you stand on equity and taxes and affirmative action and all sorts of those things that people are very divided on, that maybe give advantage to the disadvantaged and maybe give a disadvantage to the advantaged, which can be concerning for some, that what we're seeing here is a pretty complex system of how to get people into home ownership and how to offset those costs to just help it get a little bit better. I'm not seeing anything that causes the concern we had in what led up to the 2008 crash. No,
I don't see that.
Okay. And that would be, of course, all of our biggest concern is something so short-sighted that it led to an imminent crisis. This is just an overdue adjustment, and I will look at the positives as well, that if this helps people affordably get into home ownership at medium income, at medium credit score levels, and that's what these are, 640 is still considered to be that you've got decent credit. If you're struggling in the credit department, there are credit counselors that can help you. We can help you. But in the meantime, if you have any questions about what you've heard here today, you can call us. And if we can't answer the question, we're going to put you in touch with Jason Roberson from Guardian Residential Lending. Jason, thank you for being here today and helping explain some of this. I'm sure you will be getting follow-up questions.
Oh yeah, yeah. It's been a hot topic for a little bit.
And it's probably going to continue to be, but I'm really glad that we have an opportunity to have this conversation with our clients. I'm going to share this video so people can at least, first of all, know about it. Second of all, know what it really is about. And then maybe that sparks some of their own questions and they can ask us. Conversation is very important, and I'm really glad that we had it today. And thank you guys for your questions. That was very helpful. Thank you.
Thanks for having me.
Income at medium credit score levels, and that's what these are. 640 is still considered to be that you've got decent credit. If you're struggling in the credit department, there are credit counselors that can help you. We can help you. But in the meantime, if you have any questions about what you've heard here today, you can call us. And if we can't answer the question, we're going to put you in touch with Jason Roberson from Guardian Residential Lending. Jason, thank you for being here today and helping explain some of this. I'm sure you will be getting follow-up questions.
Oh yeah, yeah. It's been a hot topic for a little bit.
Yep, it has.